Most traders lose money for a strange reason. Not because they can't read a chart, not because they lack indicators, and not because the market is against them. They lose because they believe small profits are beneath them. That belief ruins more accounts than bad analysis ever will. A man risks $200 because he wants to make $2,000. He waits for the big move. He needs excitement to feel progress. But the market has a habit of punishing emotional ambition, quietly, consistently. Now think about this for a moment. What if the trader who takes $20 from the market every day understands something the crowd doesn't? What if that small gain is not small at all? Most people never stop long enough to ask that question. The market doesn't care about your financial goals. It doesn't know your rent is due. It doesn't reward need. It rewards discipline. And discipline is usually invisible because it looks boring from the outside. The 20 profit formula is not about the amount. That's the first misunderstanding. The number is symbolic. It represents controlled extraction, a repeatable gain. A trader who can consistently take $20 with calm judgment is far closer to real success than the trader chasing lottery-sized wins. Why? Because consistency changes the trader before it changes the account. You see, the market is a psychological mirror. It reveals what kind of person you become under uncertainty. Are you patient when nothing is happening? Can you sit still after missing a move? Can you accept a modest win without immediately trying to double it? Most can't. That is why they fail long before strategy becomes the issue. Watch how inexperienced traders behave after a small profit. They become uncomfortable. Strange, isn't it? You would think profit creates satisfaction. But for many traders, small profit creates irritation because it clashes with their fantasy. They didn't come for $20. They came for transformation. And that expectation poisons judgment. A trader takes a clean setup. Price moves in his favor. He closes with a reasonable gain. Then he watches the market continue another 20 points without him. Suddenly, the successful trade feels like failure. Have you ever noticed that? The market moved correctly. Your analysis worked, risk was controlled. Yet emotionally, you still felt disappointed. That emotion is dangerous because it trains you to abandon good behavior. Soon, you stop respecting exits. You widen targets. You hold weak positions longer. And eventually, one trade erases 10 disciplined ones. Not because the market changed, because your standards changed. The professionals understand something the public rarely sees. Survival creates opportunity. A trader who protects capital stays in the game long enough to recognize the rare moments when size actually matters. But if every trade is treated like a once-in-a-lifetime opportunity, eventually the market humbles you. Now let's look deeper at the formula itself. The 20 profit formula begins with one simple principle. Extract only what the market is willing to give under current conditions. That sounds obvious. Yet most traders do the opposite. They decide beforehand how much they want emotionally, then force trades to satisfy that desire. The market does not respond well to force. Strong traders observe first. They ask questions. Is the market trending cleanly or rotating aimlessly? Is volume confirming movement, or is price drifting without conviction? Are buyers aggressive or merely reactive? These details matter because different environments require different expectations. A calm market rewards precision. A volatile market rewards patience. A choppy market rewards restraint. And restraint is a skill very few traders practice deliberately. Have you ever sat on your hands for an entire session because conditions were poor? Most traders can't. They feel pressure to participate. They confuse activity with productivity. But the experienced operator knows that avoiding a bad trade is often more profitable than finding a good one. That realization changes everything. Because once you stop forcing trades, you begin to see the market more clearly. Price action becomes less emotional. You notice behavior instead of predicting outcomes. You start seeing traps. For example, inexperienced traders often buy breakouts simply because price moves quickly. But speed alone means nothing. Real strength usually has structure behind it. There's accumulation. There's compression. There's evidence of controlled demand. Without that structure, fast movement often attracts late buyers, and late buyers provide liquidity for smarter money to exit. Now here's the important part. The 20 profit formula trains you to focus on process rather than spectacle. A trader risking $50 to make 20 with consistency is building something far more valuable than profit. He is building emotional stability. And emotional stability compounds. Think carefully about that phrase. Most traders only understand financial compounding. They never consider psychological compounding. But psychology determines execution. One disciplined trade makes the next disciplined trade easier. One controlled exit strengthens future restraint. One avoided impulse reduces the power of emotional habits. And over time, this creates a trader who no longer needs excitement to function. That trader becomes dangerous in the best possible sense. Because now he can wait. He can observe weak market conditions without needing action. He can close the platform after reaching his target. He can let another trader chase revenge setups while he protects his capital. That separation is enormous. The crowd believes trading success comes from prediction. In reality, much of it comes from emotional filtration. Knowing what to ignore is often more profitable than knowing what to trade. Now, does this mean every trader should only target $20 forever? Of course not. That misses the point entirely. The formula scales. The same discipline required to consistently extract $20 is the discipline required to manage larger positions later. But size introduced too early magnifies emotional weakness. A trader who cannot handle a small position calmly will not suddenly become disciplined with larger capital. He will simply become more emotional at a higher speed. That is why gradual progression matters. First consistency. Then scale. Never reverse that order. Look at the traders who blow up accounts repeatedly. The pattern is almost always the same. Oversized positions, emotional entries, refusal to accept small losses, addiction to recovery, and underneath all of it is one belief: I need this trade to change something in my life. That pressure destroys objectivity. The market senses emotional urgency the way water exposes cracks in a foundation. Now compare that with the trader using the 20 profit formula. His objective is narrower, cleaner, more controlled. He enters with acceptance rather than desperation. And because he is not emotionally demanding extraordinary outcomes from ordinary conditions, he sees more clearly. Clarity creates timing. Timing creates efficiency. Efficiency reduces stress, and reduced stress improves decision-making. Notice how everything connects. Trading is never isolated. One emotional mistake affects the next decision. One reckless trade changes your perception for hours, sometimes days. That is why protecting mental capital matters as much as protecting financial capital. A calm trader sees opportunity earlier. An exhausted trader sees danger everywhere. So before entering any trade, ask yourself a difficult question: am I trading the chart, or am I trading my emotional state? Most people never ask that honestly. They say they follow strategy, but their behavior changes depending on boredom, frustration, confidence, or fear. In other words, the market is not controlling them directly. Their own emotional reactions are. And this is where the real edge begins to emerge. Not in indicators, not in secret systems, but in the ability to remain psychologically stable while uncertainty unfolds in real time. Because once you develop that stability, you stop needing every trade to prove something about you. You stop treating losses as personal attacks. You stop increasing size out of frustration. And slowly, almost quietly, your relationship with the market changes. You begin entering trades with less noise in your mind. You stop staring at every candle. You become more selective, more patient, more aware of how price behaves around emotional traders. And then you notice something most people miss entirely. The market often reveals its intentions not during the obvious move, but in the hesitation before it, the pause, the failed breakout that refuses to collapse, the sudden absorption of aggressive sellers, the inability of price to continue lower despite bad news. That behavior tells a story, but only traders with emotional patience are calm enough to read it before the crowd does. And once you understand that, the 20 profit formula stops looking small. Most traders enter the market believing profits come first and discipline comes later. They think once they make enough money, they'll become patient. Once they grow the account, they'll finally control their emotions. But the market rarely works that way. The habits come first. A trader who cannot manage a small position responsibly will usually mishandle a larger one with even greater intensity. Why? Because money amplifies behavior. It doesn't correct it. If impatience exists at a small level, size only magnifies the problem. That's why small profits matter more than most people realize. A consistent $20 gain may look insignificant to someone chasing dramatic wins, but the real value is hidden beneath the number itself. The profit is not just income. It's proof of controlled execution. It's evidence that the trader followed a process instead of an emotion. And that difference changes everything over time. Think about how most beginners behave. They enter trades with oversized expectations. They want one move to solve financial pressure, self-doubt, or frustration. As a result, they stop reading the market objectively. Every candle suddenly feels personal. Every pullback creates fear. Every missed move creates urgency. Now compare that to the trader focused on small, controlled profits. He approaches the market differently. He no longer needs every trade to become extraordinary. That removes pressure, and once pressure disappears, clarity improves. He waits longer before entering. He exits without argument. He accepts that not every session offers opportunity. Can you see how this changes the psychology of decision-making? Small profits train emotional restraint. They teach the trader to respect risk because survival becomes more important than excitement, and the market consistently rewards traders who think in terms of longevity rather than entertainment. Many people underestimate this because they only measure visible results. They look at the dollar amount but ignore the behavior that produced it. Yet behavior is the foundation of all long-term performance. A trader who repeatedly takes controlled profits develops habits that become automatic over time. He stops forcing trades out of boredom. He becomes less reactive to noise. Losses stop feeling catastrophic because his identity is no longer attached to one position. That emotional stability is not built during massive winning streaks. It's built during ordinary sessions where discipline is repeated quietly. The market notices impatience immediately. A trader enters too early because he fears missing out. He increases position size after a loss because he wants emotional recovery. He holds weak trades because accepting a small loss hurts his ego. These actions seem different on the surface, but they all come from the same source: lack of professional habits. Professional traders think differently. They understand that consistency is a behavioral achievement before it becomes a financial one. The account grows because the trader grows first. That's the part most people skip. They search for better indicators, faster entries, secret confirmations. But without emotional structure, even strong strategies collapse under pressure. A disciplined trader can survive with an average strategy. An emotional trader can destroy a great one. So the small profit becomes more than a target. It becomes a form of training, a repeated exercise in patience, control, and realistic thinking. Every controlled trade strengthens the ability to remain calm under uncertainty. And eventually, calm execution starts feeling normal. Most traders believe the market rewards intelligence. They assume the person with the best analysis, the most indicators, or the sharpest predictions should naturally make the most money. But if that were entirely true, many highly educated traders would dominate the market consistently. They don't, because trading exposes a weakness that knowledge alone cannot fix: emotional instability under uncertainty. The market rewards emotional control more than analytical brilliance because execution matters more than potential. A trader may identify the perfect setup, understand market structure deeply, and predict direction correctly, yet still lose money because fear, greed, or impatience interferes at the critical moment. How often have you seen traders exit winning trades too early, or hold losing positions far too long? The analysis may have been correct in the beginning, but emotion changed the outcome. That is why psychology sits at the center of performance. The market creates pressure in ways most people underestimate. Price moves against you by a few points, and suddenly your thinking changes. A trade that looked rational becomes emotional. You stop observing objectively and begin reacting personally. And once emotion enters the decision-making process, discipline weakens quickly. Fear causes hesitation. Greed creates overexposure. Frustration leads to revenge trading. Overconfidence destroys risk management. Every major trading mistake usually begins emotionally before it appears financially. Now think about the trader with average analysis, but exceptional emotional stability. He may not predict every move perfectly, but he controls risk carefully. He waits for confirmation instead of forcing entries. He accepts losses quickly without emotional attachment. He understands that one trade means very little in the larger sequence. Over time, that calm behavior compounds. Why? Because emotional control protects consistency, and consistency matters more than occasional brilliance. Many traders experience moments of strong performance. A few good trades can happen accidentally, but maintaining stable execution week after week requires emotional discipline most people never develop intentionally. The market constantly tempts traders away from their own rules. That temptation is the real test. Can you remain patient while others chase momentum emotionally? Can you stay disciplined after a winning streak makes you feel invincible? Can you accept being wrong without needing immediate revenge from the market? These moments determine survival far more than technical knowledge alone. The emotional trader becomes unpredictable. His strategy changes depending on mood. After losses, he trades aggressively. After wins, he becomes careless. He mistakes emotional confidence for genuine market opportunity, and because his internal state keeps shifting, his execution becomes inconsistent even when his analysis remains strong. That inconsistency slowly destroys trust in his own process. The emotionally controlled trader operates differently. He understands that uncertainty is permanent. Instead of fighting it emotionally, he builds behavior around it. He knows losses are part of the business, not personal failures. He doesn't need every trade to validate his intelligence or self-worth. That mindset creates clarity, and clarity improves timing, risk management, and patience naturally. The market often punishes emotional urgency because urgency narrows perception. Traders begin seeing only what supports their position. They ignore warning signs. They stop listening to price behavior objectively because they become attached to outcomes emotionally. Strong emotional control prevents that blindness. It allows the trader to adapt without panic, to exit without ego, to wait without anxiety, to trade without needing constant stimulation. And that level of stability becomes a greater advantage than prediction itself, because the market does not reward the trader who feels the smartest. It rewards the trader who can remain the calmest while uncertainty unfolds in real time. Most traders say they want freedom, but many of them are actually searching for excitement. That confusion creates enormous problems in trading because the market punishes emotional stimulation disguised as ambition. A surprising number of traders do not struggle because they lack strategy. They struggle because they unconsciously need action. They need movement, intensity, and emotional highs to feel productive. Quiet discipline feels too slow for them. Patience feels empty, and because of that, they begin forcing opportunities that never truly existed. Have you ever noticed how difficult it is for some traders to stay out of the market during slow conditions? Even when price action is weak, volume is inconsistent, and setups are unclear, they still enter trades. Why? Because inactivity feels uncomfortable. The emotional mind starts creating pressure. Maybe this move will run. I don't want to miss it. Something is better than nothing. That internal dialogue usually leads to low-quality decisions. The market becomes dangerous when trading shifts from observation to emotional entertainment. Once excitement becomes part of the motivation, discipline starts disappearing quietly. The trader increases size too quickly. He takes setups outside his plan. He holds positions longer than necessary because he wants a dramatic outcome instead of a professional one. And slowly, trading stops being a business process. It becomes emotional stimulation. This is why many traders experience exhaustion without progress. They are constantly active but rarely productive. Every session becomes an emotional roller coaster. Big hope during entries, stress during pullbacks, euphoria during temporary profits, anger after losses. The account fluctuates, but emotionally they remain trapped in the same cycle. Now compare that to the trader who understands that successful trading is often repetitive and uneventful. He does not need constant action to feel engaged. He understands that most market conditions are mediocre. He knows high-quality opportunities are limited. Because of that, he becomes selective rather than reactive. That selectiveness protects both capital and emotional energy. The truth most beginners resist is that profitable trading often feels boring. Not because it lacks importance, but because emotional chaos is absent. Strong traders are not searching for adrenaline. They are searching for favorable conditions and controlled execution. That difference changes behavior immediately. A trader addicted to excitement struggles to exit winning trades because he wants more emotional reward. Small, clean profits feel unsatisfying to him. He wants the huge move, the dramatic story, the screenshot-worthy result. And ironically, that desire usually causes him to lose the profit he already had. Excitement creates distorted expectations. The trader starts believing every trade should become extraordinary, so when normal market behavior appears, pauses, pullbacks, slow movement, frustration begins building internally. That frustration leads to mistakes. He enters too early because waiting feels dull. He overtrades because silence feels uncomfortable. He ignores risk because emotional excitement becomes more important than consistency. Can you see how dangerous this becomes over time? The market rewards calm observation, but excitement reduces observation quality. Emotional stimulation narrows focus. Traders stop reading context objectively and start chasing emotional satisfaction unconsciously. That is why patience is not just a personality trait in trading. It is a competitive advantage. A patient trader can sit through weak conditions without emotional pressure. He can wait for confirmation while others rush impulsively. He understands that missing bad trades is part of professional behavior, and because he no longer needs constant stimulation from the market, his decisions become cleaner. The emotional trader experiences the market like a casino. The disciplined trader experiences it like a probability business. The difference may sound subtle at first, but over hundreds of trades it becomes enormous. One mindset seeks excitement, the other seeks controlled opportunity, and eventually, the market exposes which one was stronger all along. Because the trader who constantly needs excitement eventually begins creating risk where no real opportunity exists. Most traders become obsessed with large wins because large wins are visible. They create excitement, attention, and stories people want to tell. A trader doubles an account in a week, catches a massive breakout, or turns one position into a huge gain, and suddenly everyone pays attention. But what people rarely see is what happens afterward. In many cases, those same traders give the money back because the foundation underneath the success was unstable. The result looked impressive, but the process behind it lacked consistency. And without consistency, trading becomes unpredictable. The market does not reward occasional brilliance for very long. It rewards repeatable behavior. A trader who can execute the same disciplined process across changing conditions will survive much longer than someone relying on emotional bursts of performance. That's why consistency is the real edge. Large wins are often just byproducts of strong habits repeated over time. Think about how professionals operate in any performance-based field. They do not wake up searching for extraordinary moments every day. They focus on repeatable standards. The repetition looks ordinary from the outside, but that ordinary behavior creates extraordinary long-term results. Trading is no different. A trader who manages risk consistently, enters selectively, and exits without emotional attachment builds stability over time. Stability may not feel exciting in the moment, but it creates something more valuable than excitement: reliability. And reliability changes how a trader thinks under pressure. Have you noticed how emotional traders constantly swing between confidence and fear? After a few wins, they feel unstoppable. After a few losses, they question everything. Their mindset changes because their performance depends too heavily on short-term outcomes. The consistent trader behaves differently. He understands that any single trade means very little. His confidence does not come from one big win. It comes from trusting his process across many repetitions. Because of that, losses feel manageable rather than catastrophic. This emotional stability allows him to think clearly while others panic. Now here's the important part many traders misunderstand. Consistency does not mean winning every trade. That idea destroys discipline because it creates unrealistic expectations. Consistency means maintaining controlled behavior regardless of outcome. A disciplined loss can still be a successful trade. An emotional win can still be a dangerous trade. Most people judge trading quality only by profit and loss, but experienced traders judge quality by execution. Why? Because execution can be repeated. Random emotional success cannot. The market constantly tests this principle. A trader follows his system for several sessions and sees small gains. Then suddenly another trader catches a massive move and posts huge profits publicly. Immediately, impatience begins building internally. The disciplined process now feels too slow, and that feeling becomes dangerous. Because once consistency starts feeling boring, traders begin abandoning the very behavior protecting them. They increase position size unnecessarily. They force trades outside their plan. They chase volatility emotionally. All because they became distracted by dramatic outcomes instead of sustainable performance. The irony is that large wins usually come naturally to disciplined traders eventually, but they arrive as secondary effects, not desperate goals. Strong traders do not force big opportunities. They position themselves patiently so they can recognize them when conditions align properly. That patience matters, because the market rarely rewards emotional urgency for long. Traders chasing immediate transformation often become reckless without realizing it. They stop respecting process because they become emotionally attached to outcomes. The consistent trader avoids that trap. He understands that long-term performance is built through small, repeatable decisions made correctly under pressure. One disciplined entry, one controlled exit, one avoided mistake, again and again, and over time, those quiet repetitions create something powerful. Not just financial growth, but psychological confidence built on evidence rather than emotion. That confidence becomes steady because it no longer depends on dramatic wins to survive. Most traders believe success comes from finding opportunity. But in reality, success often comes from surviving long enough to recognize the right opportunity when it finally appears. That difference changes how professionals think about the market. An inexperienced trader treats every setup like it must become meaningful. Every trade feels urgent. Every move looks important. And because of that emotional intensity, he risks too much too often. He believes constant action creates progress. But the market does not provide high-quality opportunities every day. Sometimes conditions are clean, directional, and structured. Other times the market becomes noisy, indecisive, and emotionally deceptive. Strong traders understand the difference. Weak traders ignore it because patience feels uncomfortable. This is where survival becomes a real advantage. A trader who protects capital during poor conditions remains emotionally and financially prepared for stronger opportunities later. That sounds simple, yet most people underestimate how important it is. Why? Because emotional pressure creates short-term thinking. When traders become desperate for immediate results, they stop evaluating market quality objectively. They begin forcing trades during weak environments simply to stay active. The account slowly weakens, confidence deteriorates, and by the time genuine opportunity appears, they are already damaged emotionally. Sometimes they lack capital. Sometimes they lack confidence. Sometimes they lack clarity, and all three are dangerous. Now compare that to the disciplined trader focused on survival first. He understands that not every session deserves participation. He recognizes when the market lacks structure. Instead of chasing random movement, he waits. He preserves energy. He protects his account from unnecessary exposure. At first glance, this behavior looks passive, but it is actually strategic restraint. The market rewards traders who remain mentally clear long enough to exploit rare moments of alignment. Those moments do exist. Strong trends emerge. Clean breakouts form. Institutional momentum becomes visible. But these opportunities are valuable precisely because they are uncommon, and uncommon opportunities require preparation. Have you ever noticed how emotional traders often miss the best setups? Not because they failed to see them, but because they were already exhausted from forcing low-quality trades earlier in the session. That exhaustion affects judgment more than most people realize. A trader who spends hours fighting choppy conditions becomes emotionally reactive. So when the real opportunity finally appears, he hesitates. Or worse, he overtrades it emotionally because frustration has already weakened discipline. The professional trader avoids this trap by conserving both capital and emotional focus. This is why survival creates opportunity. It keeps the trader available. The market is a long game, but emotional traders approach it like a sprint. They want immediate transformation. They try to force growth before building stability. And because they underestimate the importance of endurance, they expose themselves unnecessarily during mediocre conditions. Over time, that behavior becomes destructive. One careless trade leads to emotional recovery attempts,